Protecting against losses while capturing growth is a key goal for investors, but traditional risk management approaches can fail. Typically, bonds are expected to counterbalance stocks. This works until both fall together. And moving to cash means missing opportunities and losing to inflation. The Cboe U.S. Large Cap 10% Buffer Strategies Fund addresses these challenges, seeking to cushion or buffer a targeted level of losses, while allowing participation in upside growth. The fund utilizes the options-based 10% buffer strategy, which seeks to buffer the first 10% of annual losses in U.S. large cap equities. In return for this buffer, there is a cap on investment gains. For example, if a U.S. large cap equity index, such as the S&P 500 index, or an ETF that tracks a U.S. large cap equity index, such as the SPDR S&P 500 ETF, drops 15%, the 10% buffer strategy seeks to hedge the first 10% of losses, resulting in a 5% net loss. Conversely, if the U.S. large cap equity index or ETF rises, so does the strategy, but only up to the growth cap. The average cap for the fund is 15%. Investing in one strategy with a single maturity for a prolonged period risks incurring losses below the buffer range or limiting growth above the cap. The fund, however, invests in a laddered portfolio of 12 10% buffer strategies. Every month, the oldest strategy matures, and its performance is rolled into a new one-year strategy, with cap and buffer levels reset to prevailing U.S. large cap equity index or ETF levels. As a result, at least part of the investment is likely to continue to participate in gains as the market rises and be buffered as the market declines. Appropriate in low-risk equity or alternative sleeves of a portfolio, the fund aims to provide equity exposure with less volatility. Visit cbovest.com/mutual-funds to learn more.